So the Fed has been manipulating markets for a long time. And on top of that, obviously, we've had incredible amounts of free money, fiscal stimulus. Last month, there was another round of checks, and I don't think a lot of people are aware that about a third of last month's personal disposable income was given by the government. Also, the government is running a deficit that's about 30% of GDP in terms of their spending, and they're only paying for a little less than half of it. So there's a lot of distortions that are going on, but with the money that's flowing, it's helped to distort many economic theories and also the value of most asset classes.
We're going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
This effort. And China has big plans for this. They intend to seed their digital yuan into the global environment by giving it away to visitors at next winter's Olympics. When they arrive at the airport, they're going to get yuan digital wallets. They're going to receive digital yuan. They're going to use it throughout their visits to Beijing, and then they're going to take it back to their home countries. They see this as a huge advantage. Why? Because who controls the underlying protocols, who controls the underlying standards of the future of money will control the future of money.
Welcome to the Crypto Teacher. And guys, I come back with that video just to make you think. And we have Jeffrey Gundlach speaking the truth about the Fed. We know the Fed is manipulating the stock market and cryptos, but we know the reason why, and that's the fourth industrial revolution. Jeffrey Gundlach is one of the few people they allow to tell the truth, but he never tells the whole truth. And no one is speaking about the fourth industrial revolution, but we're going to set that to the side. As we know, they did all this money printing for a reason. They're giving out this free money, but we know that cryptos are going to allow them to give out free money without inflation. Remember, guys, they have to cause the problem, wait for the reaction, and run in with the solution. And then also we had CNBC speak about Bitcoin dropping down, but again, they don't give the reason why like Jeffrey Gundlach did. As he stated, when we have rising yields, we have inflation. That is going to dig in to these actual shale companies and also speculative assets. Stocks like Tesla, the charging stations, they're not going anywhere. Cryptos, when we're looking at Ethereum, it's not going anywhere because we know it's for the fourth industrial revolution. Same thing when we look at Bitcoin. We know behind the scenes is Bitcoin Lightning, Facebook Diem. So yes, is cryptos taking a dip right now? Yes, but we know that cryptos are going to move right back up. Is it going to the highs where it was at before? No. Right now, we're going to be making higher lows. Do not let this dip scare you. Because remember what I teach you guys. Yes, finances is boring. But when you learn the New World Order, you learn that everything is planned out. You have a wonderful day.
Well, the chart master, as you recall, called the Bitcoin breakdown back in April. So let's take a listen.
One reference point is the January peak, and you can see the line I've drawn there. Look at the next chart. Another reference point is the 150-day moving average. Now, take a look at the next chart. It's those all put together. They all triangulate. They all come down to around the 40,000 plus level.
Cornerstone Macro's Carter Worth joins us now with an updated take on where Bitcoin could be headed next. Carter, what do you see?
Well, it's what do you say? It's fascinating, it's frustrating, it's enticing, and let's try to figure it out together. A couple charts. So the first chart, we know that it was sitting around 10,000 Bitcoin last summer and autumn, and we went on this six-fold increase up to the peak of just 1 month ago on April 14th of 64,000 and change. And then we broke trend, which you can see on that chart. Second chart. If you do break trend, are there reference points? Well, one is the prior peak, an intermediate top, and that would be that Jan 8th top at around 42,000. Now put those two charts together, next chart, and one reference point is this prior high. But the question about a prior high is it support? One point in time, not particularly good support. So now look at the next chart. Support is not a plywood board or a concrete floor, it's a mattress top. We're down to support, but you can sink into support, like a child jumping on the bed in the hotel room. So next chart. We're down 35% now. Were we to get to the bottom of support, we would be down 55%. And you can see that on the next chart. The final chart, this is sort of all data going back to 2011. And the question is, we're down 35% now. Could we draw down 55? Of course we could. So put it in context. There have been 11, you can count them, 30% plus declines in Bitcoin going back to 2011. And the average decline of those is about 56%. Some have been 80, 85, others have been shallower at 30, 35, but they all average out around 55. Were we to go down 55, we would be at the lower end of support. I think we're in support, it's fighting, but my hunch is it goes lower.
I want to shift topics and bring up cryptocurrencies, Bitcoin specifically. I know you have commented on past webcasts about Bitcoin. We saw Bitcoin drop, I think it was something like 10% because of an Elon Musk tweet that came out yesterday about no longer accepting Bitcoin for payments of Teslas. You saw the news, but they'll keep it on their balance sheets. What do you make of what's been going on in the Bitcoin space?
The Bitcoin and the other cryptos have clearly been objects of speculation. And it had a lot to do, again, with the government money. I mean, remember the GameStop thing that happened too? All these things. A lot of people are just playing with this funny money. And when you give people money that don't need it, which unfortunately we've been doing a lot, they feel like they're playing with the house's money. So it actually does resemble a casino to them psychologically. Bitcoin, I thought, was really low at the beginning of 2020. I was really bullish on it. I went so far as to say I think it's going to go to 15,000 when it was at 4,000. And I looked like an idiot by the summer because it was still languishing at around 5,000 or so. But then all of a sudden it blew right through 15,000. And then all of a sudden it was 23,000. And that's when I turned neutral on it, too early, obviously, because it's now double that, and it was nearly triple that. But it's moving around like crazy. This is all based upon speculative fever. It's almost like every era of really highly valued markets, after they've run a lot, has some sort of a poster child, if you will. You know, it was like some of the crazy .coms that had no revenue that were coming to market very successfully in the year 1999. Here, I think it's really these cryptos. And what I think is most interesting presently about Bitcoin is what you just alluded to, in that it's peaked. Now, maybe it's only temporary, that peak. But when you're looking at a speculative fervor, I look for the poster child to roll over last. And so these things are, the NASDAQ is underperforming the S&P 500, and it has been for a while now. It's this year to date, excluding today, because I didn't get the final prints, the NASDAQ was only up 2%, and the Dow Jones was up double digit. And so that's another sign that some of the speculative fervor might be in the process of dissipating, because for the longest time, the Super 6, which powers the NASDAQ, were tremendously outperforming everything else, and they just aren't anymore. So I always look for things that are sustained trends that get out of hand, and then quietly, without a lot of people talking about it, they roll over. And it's a sign that risk could be increasing. And I'm feeling that the market's more at risk now than it was thanks to the higher interest rates. Interest rates, I think if we take out the highs on the 30-year, which was around 2.5 or 2.55, I can't remember which, but we're at 2.4 today. So we're one really bad day away from going to a new high yield on the 30-year. I think that's something to watch out for as a risk factor. This strange thing of 8 million job openings, and everywhere you go, business people are saying, I can't fill them. No one will take them. And it was obvious when they started these money giveaways that there was going to be an issue, because right away everyone noticed that a certain fraction that was not trivial of people are making more money sitting at home watching Netflix than they are at work, and they don't want to go back. I think one of the dangers that we've opened the door to is these stimulus checks are starting to feel like they might not go away. They seem like there's always another round of them. In fact, this week, Gavin Newsom, the governor of California, announced $600 to people that are making less than something like $75,000 a year, because California, thanks to the government money, has gone into a large surplus of their budget, at least temporarily. So now in New York, state of New York and state of California, a lot of people are getting $57,000 per year tax-free by not working. So there's a lot of distortions there. We've seen big